As you view this presentation, ask yourself, if you have an IRA, a 401k, an SEP, or any of the other qualified plans, exactly how long can you live once you choose to retire based on the money in that plan when you choose to retire? If you think it through carefully, you're going to be shocked by the answers you provide for yourselves.
How to become your own source of financing and tell banks and credit card companies to go take a hike from Bank on Yourself. What if you could bypass banks, finance, and credit card companies altogether? Become your own source of financing and get access to money when you want it for whatever you want by answering just one question: how much do you want? It's easier to do than you might think. To show you how it works, let's look at the ways we buy big-ticket items like a car. We finance it, we lease it, or we pay cash for it. If you finance a car, what do you have to show for your money after your loan is paid off? Only an old car. If you lease the car, what do you have to show for it when the lease is up? Even less. You have nothing to show for the money you spent. Some people figure they can beat the financing and leasing rackets by paying cash for the car. But get this, if you save up for your car in a savings account, when you pull your money out to pay cash, how much are you now earning on that money? Nothing. And you'll only start earning interest slowly as you put the money back in your savings account. The reality is you finance everything you buy because you either pay interest when you finance or lease things, or you lose interest and investment income you could have had if you'd kept the money invested instead. So what's the solution? Well, there's a fourth way to buy things, and bank and credit card companies are desperately hoping you never hear about it. This little-known method lets you bank on yourself and bypass lending institutions altogether. When you save your money in a Bank on Yourself plan, you can borrow it to pay cash for a car or anything else you might want, and the money in your plan will continue growing as though you never touched a dime of it. So what's a Bank on Yourself plan? Well, it's a specially designed type of dividend-paying whole life insurance policy. Not the kind of policy financial entertainers like Susie Orman and Dave Ramsey talk about. No, most of your premium goes into a rider that supercharges the growth of your equity, your cash value, in the policy. The plan reduces the commission the advisor receives by a whopping 50 to 70%. And you'll have up to 40 times more cash value, especially in the early years, than with a traditional whole life policy. And you'll be able to use it as a powerful financial management tool right from the start. So who has used the Bank on Yourself method creatively and successfully? Think Disneyland. Walt Disney borrowed from his life insurance policy in 1953 to build Disneyland when no banker would lend him a dime. Then there's J.C. Penney. John Penny borrowed from his life insurance policy to meet the company payroll following the 1929 stock market crash. And these are just two examples out of many. In fact, hundreds of thousands of Americans of all ages and incomes use the Bank on Yourself method. Let's compare a bank loan with a Bank on Yourself policy loan. If you want a loan from the bank, you're going to have to fill out a credit application. They're going to run a credit check, and you've got to qualify, or you don't get the loan. But with Bank on Yourself, there's no qualifying, and you can't be turned down. A bank may limit your loan amount, but with Bank on Yourself, you can borrow up to 85 to 90% of your cash value. A bank may charge you higher interest because of your credit rating, but with Bank on Yourself, you get competitive interest rates regardless of your credit rating. When you borrow from a bank, who sets your repayment terms? The bank. With Bank on Yourself, it's your money. You set your own repayment terms. What happens if you miss a payment on a bank loan? Well, there goes your credit score. Maybe collection calls, maybe repossession, maybe foreclosure. But with a Bank on Yourself loan, you can reduce or skip some payments if you hit a rough spot financially and not have to worry about those things. Finally, when you pass away, all your bank loans must be settled by your estate. But with Bank on Yourself, unpaid loans are simply deducted from the death benefit, which, by the way, increases exponentially as your policy matures. And the best part is, your policy can double as a retirement plan you can predict and count on, providing you guaranteed growth and an income in retirement that can last as long as you do, with little or no taxes due under current tax law. In short, the typical family could potentially increase their lifetime wealth by hundreds of thousands of dollars simply by financing their cars and vacations through a bank-on-yourself policy, without taking on the risks of stocks, real estate, and other volatile investments. Want to find out how much bigger your nest egg could grow if you add the bank-on-yourself method to your financial plan? Request a free, no-obligation analysis and find out.